Did you guys see what just happened today in the news? We have the US private employers shed 32,000 jobs in November. Yikes. We're getting really unemployed out there, aren't we? We can also see the chart that follows. So throughout the year, we've actually been cutting jobs down. Well, that's very strong economy like, isn't it? We also have the weak jobs data lift rate cut hopes as stocks climb. So, a lot of you guys are saying, okay, we have hopes that we will get a rate cut. We can also see that here on the CME group, right here, 89% chance we're going to have a rate cut on December 10th for the December 2025 meeting. 11% chance that we just hold rates. So, you know what? I'll just show you guys in the chart where we're at right now. So here we have the 2-year yield. This is what the Fed follows to adjust rates. We can see we are in a descending pattern, usually breaks bullish. If you guys see on the most recent data, we broke the height of the most recent shoulder of the head and shoulders pattern, which is why we came down and then we bounced. So could we have predicted what might happen on December 10th? Yes. We can see here we're down. We can also see, if we zoom out a little bit, here is the Fed. So the Fed has to stay close to this line. Will they come down? Maybe. This is a bullish pattern, so it could break up, but if it breaks down, the rates go lower. We can see because of the head and shoulders pattern, we went flat. So I would say we might get a rate cut. We can also check the 10-year yield, which is right here. This is for your mortgage rates. If we go ahead and zoom in like so, you can see that we went down, broke the shoulder of the head and shoulders pattern, came down, bounced on this trend line that goes back forever ago. So if we break that trend line, you get lower mortgage rates. If you don't and you bounce up, we get higher rates. Now, remember the correlation between bonds and yields? When bonds go up, yields go down. So let's go take a look at TLT. So here we have TLT. This is your bond market. This is also a tradable symbol. We can go ahead and look at where the 200-day moving average is. If you guys don't remember, that is your support. If you're above it, and gives you encouragement to go lower if you're below it. And you can see, would you look at that? We bounced right off of it. So bond market looks like it's going to go up and fill that gap that we have. Cool. Back to more breaking news. So we have, following up, the stock market today, Dow, S&P 500, Nasdaq rise as weak ADP jobs data reinforces growing Fed rate cut bets. So let's go see what the fear looks like in the market right now. You guys are pretty fearful of the market going down. Now, smart investors, you guys know to buy when it's in extreme fear and sell when it's in extreme greed. So, not saying we might have a bull market, but it looks like you guys are pretty fearful. And usually, from the retail trader standpoint, there's a lot of fear. Not a lot of people are buying, and the big people are buying in to make it go up. We can jump into the charts on this one too. So here's your S&P 500. We have the tradable symbol SPY on here. I'm just going off of this one because this is the highest returning one out of the Nasdaq, Dow, and S&P 500. So you can see we came up and we're now retesting that blue line there, which is a form of resistance. Now, if we can break above that, get a full candle close above, come down, retest, and go higher, bull market. As of right now, we're kind of just sitting on it. So there's that. You also have a head and shoulders pattern that formed, which which will cause a bear market. But that's what it's looking like. And now you guys are wondering, what about gold and silver? We can go ahead and take a look at silver first. You can see we broke up out of a pattern. This was a descending wedge. I drew this a while back. I think I showed this on the first video that I ever posted. But we take our price target here, move it to the breakout, and there you go. So silver can go higher still. Looking at this chart, we also have the encouragement of the 200-day moving average, and that is that. We also have gold for all my people that love gold. You have another descending wedge, also broke out. Price target on that. Move it over. There you go. So we still have room for gold to go up. We also have the 200-day moving average below us, so we have room to the upside. So, in the end, we have the job market not going so well and stocks looking like they might turn around according to the charts. Now, that is all the bad news that I could find for today. And as usual, the solution that I'm going to keep telling you guys is start business, learn how to trade, because you can't let your money sit. Because every day you let your money sit, it becomes worthless. Like 99% of your money is just created when you walk into a bank, pull out a loan, and the bank's like, here you go. Here's a check of $10 million. And now you have $10 million. Did the bank need anything in their vault? No. They just gave you that money. But now you owe them that money. And that's just how the monetary system that we have today works because it is debt based. You can't save the dollar. So, just keep starting businesses, keep trading out there, and I will see you guys in the next video.